All right, welcome to this explainer. Let's just dive right in. Have you ever wondered how analysts look at a sprawling, chaotic global corporation and somehow, almost magically, predict its financial future? Well, it's not magic. It's a rigorous, heavily layered process called financial statement modeling. Today, we're going to dissect the anatomy of a forecast. We'll explore the structured models used to predict a company's financial trajectory, and as you'll see, mastering the math is really only half the battle.
So here's our roadmap for today. Number 1, the skeleton, building the actual model. Number 2, the brain, looking at cognitive traps. Number 3, the arena, focusing on Porter's forces. Number 4, the impact of inflation. And finally, number 5, the horizon, where we tackle long-term forecasting. Let's get into it.
Section 1. The skeleton, building the model. Building a pro forma income statement, which, is really just a fancy term for a forecasted income statement, always follows a very specific chronological sequence. Step 1 is literally always the revenue forecast. Everything flows from top-line sales. Once we nail that down, we move to Step 2, forecasting the cost of goods sold, or COGS. Step 3 brings in our operating expenses, things like sales, general, and administrative costs. And then finally, Step 4 tacks on the non-operating items, like interest and taxes.
Notice how this exact cascade visualizes with real data. Here we are looking at the Remy Cointreau Group, a major spirits company. You can see how the revenue from their cognac and liqueur segments just drops right down through the machinery of the income statement. The assumptions we make at the very top of this model absolutely dictate the operating profit margins at the bottom. It's a total chain reaction. That's exactly why your revenue assumptions have to be rock solid.
And this brilliantly illustrates the math in action. We're seeing historical and projected figures for Remy Cointreau's revenue, EBIT, and net profit. But actually, remember that an income statement doesn't just exist in a vacuum. The net income we forecast here, that becomes the starting point for our pro forma statement of cash flows. Meanwhile, retained earnings flow directly right into our forecasted balance sheet. We project working capital ratios, like days of inventory, based on our sales forecasts, which completes all the linkages. This whole interconnected web of the three statements is what forms the mechanical skeleton of our model.
Section 2. The brain, cognitive traps in forecasting.
Now, as analysts, we are honestly our own worst enemies. Studies consistently show that experts make forecasting errors mostly due to behavioral biases. The big ones are overconfidence, illusion of control, conservation, representativeness, and confirmation bias. I really want to highlight that illusion of control for a second, because let's face it, experts naturally love to feel like they are in charge. It's this tendency to overestimate our ability to control the absolutely uncontrollable. It often leads analysts to build incredibly granular, overly complicated models, thinking, hey, adding more variables increases my accuracy, right? But no, it actually leads to diminishing returns. Overfitting a model to historical data leaves you completely blind to future outliers, and adding immaterial info actually just misleads you.
So what does this all mean? If our brains naturally push us toward overconfidence and this illusion of control, how do we fix our own blind spots? How do we mathematically remedy these psychological flaws right inside our models?
Well, the mathematical cure for overconfidence is scenario analysis. It asks the absolutely vital question, where could I be wrong and by how much? Look at this breakdown for Remy Cointreau's free cash flow. Instead of relying on just one base case, we've modeled alternative scenario 1 and alternative scenario 2. By tweaking just a few variables like cognac organic growth and EBIT margin, you can see that the forecasted free cash flow for 2024 swings wildly from 300 million euros all the way down to 105 million euros. Mathematically forcing yourself to model those worst-case scenarios is exactly how you keep your overconfidence in check.
Okay, let's move to another major trap, confirmation bias. This is when an analyst totally falls in love with a stock and basically structures their research only to find positive news that confirms what they already believe. The remedy? You literally must actively seek out dissenting views. Talk to analysts who have a negative opinion on the security. Read the bear thesis. Go seek perspectives from colleagues who aren't psychologically invested in the company. By forcing those dissenting views into your model, you build a robust, battle-tested forecast.
Section 3. The arena. Porter's 5 competitive forces.
To accurately forecast revenue growth and profit margins, you absolutely must understand a company's competitive position. We use Porter's 5 forces framework for this: the threat of substitutes, industry rivalry, bargaining power of suppliers, bargaining power of buyers, and the threat of new entrants. These aren't just dry academic terms, right? These forces directly dictate a company's real-world ability to negotiate lower input prices from its suppliers or to push higher product prices onto its buyers. If a company has a strong position against these forces, it's highly likely to generate high, persistent returns on invested capital.
Now, people often ask, well, what about the government? Michael Porter's own words clear up a massive misconception here. Government is not a sixth competitive force. Why? Because government involvement isn't inherently good or bad for profitability. Instead, you analyze government policies by looking at how they impact the existing five forces. A new tax or regulation doesn't just sit outside the model, it flows directly into how buyers, suppliers, and rivals actually behave.
Section 4. The impact of inflation.
Let's look at how this builds in the real world. Inflation and deflation massively affect the accuracy of our forecasts. Check out this scatter plot, which shows the relationship between food inflation and sales volume in the UK. As the year-on-year inflation at food stores increases, look at what happens to the volume of sales. It trends firmly, noticeably downward. Forecasting revenue during inflationary periods requires a really deep understanding of price elasticity. Basically, if input costs rise, are your customers actually going to keep buying?
This creates a brutal corporate dilemma that you, as the analyst, have to model. When a company faces rising input costs, what exactly do? Well, they basically have two choices. They can choose to pass those costs on to customers through higher prices, preserving their profit margins, but running the risk of a huge drop in sales volume. Or they can accept a margin reduction to maintain their market share and keep volume high. Your pro forma income statement depends entirely on which path you believe management is going to take.
Section 5. The horizon. Forecasting the long term.
When we build a discounted cash flow or DCF model, we need to find the going concern value of the company after our explicit short-term forecast actually ends. To do this accurately, we rely on what's called normalized earnings. This is the expected level of mid-cycle earnings completely stripped of any unusual or temporary factors. Think about it. If you're examining a highly cyclical company and you base your long-term perpetuity growth on a temporary anomalous boom year, your valuation is going to be wildly, dangerously overstated. We have to strip away the noise to find that true normalized baseline.
But here's where it gets incredibly difficult. Forecasting the long term means trying to anticipate inflection points. These are those moments when the future suddenly, violently breaks from past data, usually due to technological disruption, sudden regulation, or massive economic shifts. You can regress 10 years of historical revenue data on a chart all you want, but if an inflection point hits, history is literally no longer a guide. It's honestly one of the greatest challenges an analyst faces.
I want to leave you with this final number 1. Just a 1% error. Because a perpetuity formula calculates cash flows growing at a constant rate forever, the terminal value often accounts for the vast majority of a company's total valuation. So if your assumption for long-term growth is off by just 1%, like say you assume a media company is going to grow with the economy when it's actually shrinking, that single tiny error will wildly skew your entire model. So knowing how much our own behavioral biases can distort our view and exactly how fragile long-term assumptions are, how confident are you in the next financial model you look at? Thanks for joining me on this explainer, and definitely keep questioning those numbers.